Is dividend investing one of the best tools available to retirees in order to generate retirement income? You would certainly think so based around all of the hype that we see around dividend investing. Well, in today's video, I'm going to talk about why dividend investing may not be what you think it is, and why living off dividends in retirement may actually be a bad idea in some cases. Let's get into it. So, to explain why dividend investing can be a bad idea in some cases, we're going to start with the simplest of building blocks and then start to build towards a little bit more complexity. And so let's start with the simplest building block of all. What exactly is a dividend? And so let's take a company that is earning a profit. It doesn't matter what that company is doing. They are providing services to the marketplace. The marketplace is willing to pay for those services. And all things said and done, this company can earn a profit. Well, there are essentially four things that a company can do when it earns a profit. The first is it can reinvest back into the company. Now, a company can reinvest in a lot of different ways. It can reinvest back into research and development, improving their overall product. It can reinvest into marketing, allowing its product to get more reach. Number two, a business that earns a profit can reinvest back in the business in a slightly different way by acquiring other companies. So Facebook turned a profit and started acquiring things like Instagram. Now, Instagram obviously built into a very large business in and of itself. So that acquisition grew Facebook ultimately. Number three, a company can take its profit and repurchase shares. So there are so many outstanding shares for each company. The company itself can actually take its profit and start buying back some of its shares. This is simply another way of reinvesting back within its company. Typically, you buy back shares when you think your company is undervalued. So the fourth thing that a company can do with its profits is pay a dividend to its shareholders. So if you own a share of a stock, you are a business owner, and all a dividend payment is it's a payment from the business to its business owners. Now, as a retiree, this can feel like a fantastic income strategy because you don't need to sell shares, and yet you're able to take income from these shares that you own. And it certainly can be when you compare it to other income-oriented investment strategies. So for instance, if we compare a dividend portfolio to a bond portfolio, this is where a dividend portfolio really starts to come alive for retirees. For instance, let's say we have a retiree that has $1 million portfolio, and they're investing in a bond portfolio that has a yield of 2.5%. Now, their plan is to live off either the yield or the dividend yield from either of these portfolios. And so in a bond portfolio, when this person is living off the yield, they're essentially taking that 2.5% yield, moving through time, but their principal doesn't change. And so neither does their income. They're living off that 2.5% or $25,000 each and every year into retirement. And so let's compare this a little bit differently to a dividend portfolio. Now, this dividend portfolio has a dividend yield of 2.5%, just like the bond yield. But the key difference here is there is an appreciation element to the dividend portfolio. So we also expect the stocks within that dividend portfolio to appreciate by 4% per year. And now, as you see on the screen, we see why there is so much hype around dividend investing. With the dividend portfolio, you're still gaining that 2.5% yield, but because of the appreciation element, we're seeing the principal grow through time. And so does the income as well, because again, 2.5% as your portfolio grows through time means that you're taking more and more income. But one thing that we notice within this example is that the dividend is not the beneficial piece of this comparison at all. The appreciation is. For instance, if we completely eliminate the appreciation of the companies within this portfolio, the dividend portfolio provides the same profile as the bond portfolio. And so the dividend yield isn't the special piece of this portfolio, it's actually the appreciation. And this is the key piece of information that is so often hidden within these dividend portfolio examples. It's all about the appreciation, not about the dividend yield. For instance, if we look at another example and we look at the dividend portfolio actually depreciating rather than appreciating, we actually see that the dividend portfolio is much worse than the bond. In this given example, not only does the principal of the portfolio shrink, but so does the income of the portfolio, because now that 2.5% dividend yield is based off a falling portfolio. And so we start out with $1 million portfolio, but by year 10, we have a $665,000 portfolio. And that generates about $17,300 in income. Far worse than the bond portfolio would have generated for a retiree. So as a retiree, the metric that you should care most about is something called total return. This encompasses all appreciation as well as all income that is passed to investors. And it's this total return that is the most important because the total return measures your total wealth growth as a business owner investing in these given companies. And so let me show you why total return matters much more than the dividend income generated from a portfolio. And so let's take a retiree once again who has two choices in the portfolio that they can invest in. So the first option is a very solid income generating retirement portfolio that holds a lot of high dividend paying stocks. These stocks have an average dividend yield of 3.5%, and we expect about 4% appreciation from this given portfolio. So that's option one here. So on the screen, we'll simulate this portfolio through time, adding a little bit of volatility, and then we'll map this retiree's income as well as overall portfolio so you can see exactly what this portfolio offers to this given retiree. The second option this retiree has is a diversified growth portfolio. Now, this is still a balanced portfolio of growth as well as safety, but it pays absolutely no dividends to this given retiree. And so in order to create this income from this given portfolio, this retiree is simply going to sell 3.5% of his account each and every year and take that as income. Now, as a retiree or soon to be retiree, which portfolio would you feel most comfortable with? Well, not to be rude, but it doesn't matter because these two scenarios deliver the exact same outcome. The reason being is because they have the same exact total return. In one case, part of that total return is coming from the dividend. In the other case, the total return is coming all from growth. But they have the exact same scenarios. They deliver the exact same growth. They deliver the exact same income. And so we see that the dividend is neither a plus or a minus. It's simply part of that total return. And so as a retiree, you shouldn't care whether the company generates your income in the form of a dividend or whether you generate your own income from a diversified portfolio. Either way, you are generating the income. And so our financial industry creates this imaginary line between growth as well as income. In retirement, you want income, but in the accumulation phase, you want growth. This is a mistake. In all phases of your investing career, you simply want the highest total return for the level of risk that is prudent for your situation at that time. Whether that total return comes from growth or whether it comes from income, you ultimately don't care. To drive my point home, we're going to take a look at another quick example here. We're going to use the same dividend portfolio that generates a 3.5% dividend and has appreciation of the underlying companies of around 4% per year. Then we're going to take a look at another diversified growth portfolio. Now, this growth portfolio still has balance of growth as well as safety, but generates absolutely no dividends. But this time it has a total return of 8.5%. And so in both scenarios, the retiree is going to be generating 3.5% from this given portfolio. In the first example, we're going to look at the dividend generating that income. In the second example, this retiree is going to have to sell some of their investments in order to generate that 3.5% yield. Now, again, in both scenarios, let's assume they have the same risk expectations, but we see that the growth portfolio, when we're generating our own income, wins very handily. And this is not surprising because it has a higher total return. And so to reiterate, it's all about the total return, not about the income side of things, not about the appreciation, but the total return altogether. Now, it's important to understand that I'm not a hater of dividends. Dividend investing has some things going for it. For instance, in order to pay a dividend, a company has to turn a profit. Now, investing in companies that turn a profit typically isn't a bad idea. Dividend-paying companies typically have strong fundamentals, strong earnings, and anytime you invest in a company that has some strong fundamentals, again, that isn't a bad investing strategy, all things considered. But once again, it's not the dividend that makes a company valuable or not valuable, it's actually the profit. And remember, there are 4 things that a company can do with that profit. And so picking companies that turn a profit and then only pay that out as a dividend seems like a fairly arbitrary choice in terms of an overall investing framework. For instance, there is a concept called shareholder yield. This has been written about by a few different firms within the investment industry. And shareholder yield includes not only the dividend yield that is being paid out, but also share buybacks. And so basically, again, what a share buyback is a company is taking its profit and it is going out into the marketplace and purchasing some of its outstanding shares. Now, share buybacks typically happen when the management team thinks that the shares of its given company are undervalued relative to what they think they should be valued at. So on the screen, you can compare shareholder yield to simply just investing based on dividend yield. And as you'll see, historically, shareholder yield has delivered outsized returns relative to dividend yield. And so it's very important as you're thinking about why you're investing in dividends to make sure that you're getting the full distance out of that general framework. If you're investing in dividends because you care about companies that turn a profit, Well, a dividend isn't the only way that a company can show that it earns a profit. There again are 4 other ways that a company can turn a profit and then invest that given profit. And it's also important to note that at times a dividend can actually be a downright bad thing. And this would be the case if you're holding dividends and not taking that dividend as income within your taxable account. So let's take a retiree that was planning on living off dividends early in retirement while they were delaying Social Security. Then once they got past Social Security and into their 70s, they were forced to take RMDs. Now, an RMD is forced income, but so is a dividend. A dividend is also a form of forced income. And the issue is when we're taking a dividend and we're not taking that as income and instead reinvesting that back within our taxable account, we create something called tax drag. Now, this tax drag is created when you're forced to take a dividend. So you have an investment that's, let's say, growing at 6% per year, and you're forced to take a 2% dividend from that investment. Now, ultimately, you don't need that income, and so you simply reinvest those dividends back in and purchase additional shares. Well, the problem here is when you took that dividend, it created a taxable event. And so the amount that you're reinvesting then after taxes is a smaller amount. This will greatly affect your compounding moving through time. And so on the screen, you'll see a chart of just how destructive dividend tax drag can be within a taxable account. Now, again, it's important to note that this is just when you're reinvesting that given dividend. If you're taking that dividend as income, there is not a tax drag because the tax drag is created, once again, by reinvesting that dividend. But we see at each dividend point on this chart that the dividend ultimately lowers the amount of wealth that you will ultimately grow and then pass on potentially to the next generation. And so for many retirees, this idea of living off dividends and never touching your principal is a fantastic idea. It's an incredible idea, and it's often sold that way. But as a retiree, you need to understand that the dividend is nothing special. And in fact, every benefit that we receive from that dividend can oftentimes be captured in a different way. Now, this doesn't mean that we hate dividends, and you should too. You just shouldn't allow dividends to hold your portfolio back. Again, the most important thing that you need to consider as a retiree is your total return. That's income as well as growth added together. We ultimately don't care which category that total return comes from. We ultimately just care that that total return is the highest for the level of risk that is prudent to take for our situation at a given point in time. Now, if you're someone who will be in retirement over the next few decades, dividends aren't the only conventional idea that may be holding your retirement portfolio back. And in fact, in this video right here, we talk about one of the most common investments that retirees often hold and why this investment is going to underperform expectations in the coming decades. And we'll show in this video, in today's high inflation environment, finding an alternative for this low yielding asset class may be more important than ever. Again, click on this video if you want to learn more. As always, thank you for watching. And remember, you don't need more money. You need a better plan. We look forward to seeing you in the next video.